Well, the market still isn't sure if rising oil is going to topple the bulletproof U.S. consumer or the bulletproof Chinese economy, or maybe both. But this chart from Jason, our guest host today, shows that if American spenders flinch at the gas pumps, guess what? It's going to hammer GDP. Consumer spending now makes up 71% of the overall economy. Now, guys, this is way above the historical average of 65%. We've jumped from 65 to 71% in terms of the consumer, and it's accounting for the GDP growth. As for China, well, they're already worried. You got rising gasoline prices today by the most in more than 2 years. So who's going to get hit us hard? Who's going to get hit?
Hardest.
There we go.
You just coined a new phrase.
By all of this, is it
like
China?
That.
Is it the U.S.? Or maybe both? And what's the effect on the markets? We got two people, investors, that are breaking it down right now with two different views on the markets. We have Barbara Marcin, portfolio manager at Gamco Investors. We've got Charlie Bobrinskoy. He's director of research at Ariel Investments. Great to see both you guys. Barbara, I'll kick it off with you with the big question. Who gets hit the hardest in your opinion, China or the U.S.? What is it going to mean for the markets?
Well, China, I think, is not going to have a hard landing. I think they're just slowing down here. They had a 8% target in the last 5-year plan starting in 2005. They lowered that, and they beat that every year. They lowered that last year at the start of the next 5-year plan to 7%. So I have to think they can beat that. A hard landing would be, say, growth of maybe 5%, which could have dramatic effects. But I think China will be able to manage that growth most likely over the next few years.
And the U.S., Charlie?
Well, remember, you have to define things. A hard landing is, as Barbara was saying, a 5% growth rate. So it's not that bad. That would tend to put some pressure on commodities. Things like copper, maybe oil, wouldn't go up as much. But again, we're still talking about 5% growth. So we don't think China slowing to that rate has a significant negative effect.
Okay, but what about the U.S.? I mean, what's it going to actually mean for the U.S. consumer? You just saw the GDP chart. I mean, what's it going to do to our ability to spend and therefore power our economy?
So you have to go name by name. There are different companies, different sectors in the economy that have more or less exposure to China. Equipment manufacturers, again, commodities will have more. Consumer products companies, very little effect.
Jason, this is really bothersome. I mean, the idea, in some ways, I guess, it's interesting that the consumer's accounting for so much more of GDP, right? I mean, talk to me about that. What's going on there?
Well, there's two things that are, a big part of that almost is it looks like the mirror image of the interest rate. So if you look at really when it bottomed, it was in early '82 when interest rates were very high. So essentially the consumer's just gotten a lot more leveraged. What is surprising is that the consumer's portion of GDP altogether has actually gone up or has stayed the same over the last 3 years during a period of deleveraging. And in my view, that's mainly because you've tried to use government spending to bolster consumer spending. The problem is...
But is the government crowding out? It's that old fiscal formula, right? The government crowding out the consumer.
Not out of interest rates, but I would say in the future, the U.S. is going to be much more dependent upon the other parts of the GDP equation, which are capital spending and exports, if it wants to grow. I think you've reached a natural limit in terms of what consumer spending can contribute to the overall economy, given the access to credit and low interest rates. And I also think in terms of government spending, it's very difficult politically to get another fiscal stimulus package. On energy, the one other thing I would say is that 35% of China's CPI is driven by food, another 12% by energy. It's much more, because so many people are living at a subsistence level, it's much more subject to swings in commodity prices than the U.S. is, where we spend about 8% of our GDP on food and maybe a little bit more on commodities, maybe 10%. So
China gets hurt.
China gets hurt more just because it's much closer to the edge. You have fewer natural stabilizers.
Well, Charlie, let me ask you then, as you hear Jason share those numbers, does that actually sort of undermine the notion of this growth of the Chinese middle-class consumer? Is that cause for concern?
No. I mean, we're talking about coming from a very low level. The consumer in China is going to continue to grow. Wages are going to continue to head up. Urbanization is a continuing multi-generational process. There may be ups and downs, but the general increase in wages in China is going to continue. Demand for basic foodstuffs is going to continue to grow.
Now, Barbara, Stephen Shork of the Shork Group has made the observation that if you get gasoline here in this country above $4, you get it to $4.25, you destroy demand. What has your work done you and what told you, and what are you doing about that to reflect those concerns potentially in your portfolio?
Well, in the past, we have seen the consumer able to weather prices, say, somewhat above that. I don't know if it's $4 or $5 that really begins to crimp spending. But as Jason was talking about, you know, the background for the consumer right now is a deleveraging mode. The percent of consumer debt to personal disposable income really grew tremendously in the 90s and until our crisis in 2007 and peaked at about 130% and has only made some headway down from there. So I think consumers are have a background of deleveraging and very little excess spending to do. I think we saw that supported by January retail numbers, which disappointed, February, which sort of met expectations. So
but there's a big if out there, Barbara, and that's that if the jobs situation continues to improve and maybe starts to improve in a more dramatic fashion, people will feel as though they're a little more willing to maybe go out and do a little spending. With all that's going on, I'm curious to know where both you guys are coming out on the investing side. We did briefly hear from Charlie. I want to get his picks again, but Barbara, first off to you, what do you buy in this kind of environment given your scenario?
Sure. Well, I think we're looking at another year or two of very slow growth, and at some point we're going to have to raise taxes and cut down on spending to address our debt levels. So against that kind of longer-term low-growth background, I think companies that pay a dividend, give you a good current return, and can grow that dividend over time will be are really the place to be. I think this is one case in which the Federal Reserve has pushed you in that direction, and the obvious choice is the right one.
Okay, Kraft Foods, Vodafone, Pfizer, all on your shopping list. Charlie, what do you like?
We think the economy is still recovering. We're building homes at a rate of something like 600,000 a year. That number was 1.5 million recently. It should average closer to 1 million. So we're still going to be having an improving economy. More people are going to be going to work a year from now than today. So all of these things are going to mean actually financials are going to do very well because they're levered to the economy, and consumer discretionary stocks are going to continue to do very well.
But Charlie, it sounds like investors may have to be patient in the interim. Is that right?
But nobody knows what's going to happen short term. I mean, anybody that comes on and tells you what's going to happen the next month is kidding themselves. We got to have to look at longer term trends. The stock market is very reasonably priced for this point in a recovery, which we think is going to continue, relative to bonds, which are still overpriced.
Okay, and you, for the record, like Morgan Stanley and Goldman Sachs.